Howdy, Jacob here. Today we're looking at air products and chemicals in the chemicals industry. 58.4 billion market cap on 68.3 billion enterprise value. 10.4 billion to 12.6 billion. You're looking at about 1% CAGR over the last 10 years. So very small growth. And operating margins and gross margins are both up. So that's a positive, meaning that their bottom line is increasing more than their top line. So the company is becoming more efficient. Their return on invested capital is right around that 10% mark, very likely above their weighted average cost of capital. So they are creating business, which is a positive. Their balance sheet shows 1.6, just under $2 billion in cash-like products, with 875 million due in short-term debt, 9.4 billion long-term debt. That looks like a lot, but let's see what it is in relation to cash flow. So let's see, about $9 billion. And, okay. Capital expenditures are growing like crazy through acquisitions and reinvestments, so much so that the free cash flow is actually negative. If you watch this channel at all, you know free cash flow, lifeblood of the business, that's the most important thing that I care about. And so here, I'm just going to get straight to making assumptions. It's likely not going to be very pretty. Due to the fact their cash flow margin is not great. I mean, earnings margins are great. So are a lot of if you've ever seen me do a dividend, in my dividend style screeners, there were a lot of natural gas companies like maybe Excel or just a lot of gas producing companies where they kind of have a moat in their particular region, but they don't produce free cash flow because just to upkeep the infrastructure requires all the cash from operations that they have. And so they actually don't produce anything, but they still have a dividend. And what you see from that is the company going into more debt, more debt, more debt. And we see that here where they're just introducing debt because they can't afford this $1.5 billion aggregate dividend. And so I don't want to take too long on a company that's just very likely not going to be worth my time. So I don't think there's going to be a lot of growth, maybe 2. Let's go 12. Margins. Okay, let's do 18.9. I'll be generous on the free cash flow margin. Share change, 57 million. Stock-based compensation. I mean, let's just call it 0%. The dividend, they can't afford it. They cannot afford $1.5 billion in aggregate any year since ever. 2016. That was the last time they could afford the dividend in aggregate that it is currently. And so, I mean, I'm gonna cut it in half. They probably won't do that, but they're just gonna go more into debt. This is not the type of company that I'm very interested in. 81% off a buy price based off these assumptions, but again, doesn't take into consideration their debt. And I'm not attracted to companies that just issue debt because they can't produce positive free cash flow. Free cash flow is what I look for. So, yeah, probably not a company I'm going to be getting interested in anytime soon. Hope you enjoy the video, though, and have a great day. Thanks.